Welcome to this explainer. Look, if you're a trader, an investor, or honestly just someone fascinated by market mechanics, you're going to want to pay close attention today. We are looking at an urgent, high-stakes regulatory shift that is about to fundamentally rewrite the rules of the Indian equity markets. We're talking about the new framework from SEBI hitting the markets on August 3, 2026. This totally changes how a stock's daily closing price is determined. Imagine this for a second. You're watching the charts, managing your positions, adrenaline is pumping, and then, boom! Right at 3:15 p.m., regular trading suddenly halts. No more continuous matching. The market effectively stops dead in its tracks for a huge segment of stocks and kicks off a highly structured, suspenseful countdown to the closing bell. It's an abrupt reality, and it's absolutely going to test every trader's reflexes and preparation. Okay, let's dive into this. We'll start with the new closing bell and the timeline shift. Then we'll break down the math step by step through Phase 1, reference price, Phase 2, the price band, and Phase 3, final equilibrium.
So Section 1, the new closing bell. What exactly is changing here?
Historically, you know the drill. The closing price was just a simple average of the last 30 minutes of regular trading. Well, SEBI is tossing that old system entirely. Instead, we are entering the era of the closing auction session, or CAS. This is a dedicated matching session designed specifically to figure out that daily closing price. But, and here is the massive caveat you have to understand, this does not apply to the entire market. This new process applies strictly to equity shares that have futures and options or F&O contracts.
So let's look at the cascading effect this has on the broader market. If you're trading non-F&O shares, honestly, nothing changes for you. Those stocks continue normal continuous trading right up until 3:30 p.m. But for F&O eligible stocks, you are thrown right into the CAS. And because the equity market is going to be incredibly busy settling these complex closing auction prices, there's a knock-on effect. Trading for equity derivatives, the F&O contracts themselves, will now get an extra 10 minutes of action, keeping the game going until 3:40 p.m. Moving on to Section 2, the timeline shift. Let's walk through a day in the life. We really need to feel what the final half hour of the trading day is going to be like under this new regime. Think of this timeline as your new survival guide. At 3 p.m., the intraday cutoff hits, triggering end-of-day settlement for intraday positions. Then comes the shock at 3:15 p.m. Regular trading halts completely. From 3:15 to 3:20 p.m., you're in this weird transition period. You can queue up new orders, but they aren't sent to the exchange yet. You're effectively waiting in the dark. At 3:20 p.m., the auction officially begins and orders open. At 3:25 p.m., the rules tighten up, limit orders only. And finally, at 3:28 p.m., the randomized closing window begins.
All right, Section 3, Phase 1, reference price. This covers the window from 3 p.m. to 3:15 p.m. To ground all these abstract rules in hard numbers, let's use a fictional case study, ABC Limited. And this brilliantly illustrates exactly what happens behind the scenes between 3 p.m. and 3:15 p.m. See, before the auction even starts, the exchange needs a baseline. They look at all the trades executed in that 15-minute window right before the halt. Look at our log for ABC Limited here. We have 3 trades. Trade 1 for 500 shares, Trade 2 for 300, and Trade 3 for 200. So total volume traded is 1,000 shares. By multiplying the quantity by the trade price, we get the total value for each trade, which adds up to 2,506,000 rupees.
Now, why do those numbers actually matter? Because they give us our VWAP, or volume-weighted average price. You literally just take that total trade value of $2,506,000, divide it by the total volume of 1,000 shares, and you get exactly 2,506. This number, 2,506, is absolutely crucial. It becomes the official baseline reference price that SEBI's system is going to use to anchor the rest of the entire auction. Which brings us to Section 4, Phase 2, the price band, running from 3:20 p.m. to 3:30 p.m.
This phase is where the exchange sets up its protective guardrails to prevent wild price manipulation. But actually, scratch that. Before we even calculate those guardrails, we have to pause and ask the single most critical question every trader will have. What happens to your existing orders when the clock strikes 3:15 p.m. and the market suddenly stops dead?
Well, the answer is a ruthless system purge. If you had grand, complex trading plans, you can say goodbye to them. The only existing orders that actually survive and carry forward are standard limit orders that fall strictly inside the new plus or minus 3% price band. Everything else, killed immediately. If you've got stop-loss orders, immediate or cancel orders, orders with disclosed quantities, or limit orders sitting outside that 3% band, the exchange cancels them instantly. They are not participating in this auction.
So clearly, figuring out exactly what that 3% band is a pretty big deal. Let's look at the math for our friend ABC Limited. Our reference price is $2,506. The exchange calculates a strict 3% parameter around this. The lower limit drops down to $2,431. The upper limit rises to $2,581. These are your absolute mathematical boundaries. Any order outside these specific numbers is as good as dead.
Let's see just how merciless this system really is in practice. Trader A puts in a buy limit at $2,560. Bam, accepted. It's safely inside the band. But look at Trader B. They aggressively try to buy at $2,600. Status? Rejected. It's above the $2,581 upper limit. Trader C successfully places a sell limit at $2,450. But Trader D, trying to panic sell at $2,400, entirely rejected for falling below the $2,431 floor. Make no mistake, if you haven't calculated these limits correctly, the system simply shuts you out. No exceptions.
And you know what? The restrictions get even tighter as the clock ticks. At exactly 3:25 p.m., we hit the order lockout. If you try to place a market order in a panic at 3:26 p.m., you're going to find yourself completely locked out. Market orders cannot be placed, modified, or canceled. From 3:25 onward, you're only allowed to place or modify limit orders. The exchange is basically forcing you to name your exact price to stabilize the order book.
All right, Section 5, Phase 3, Final Equilibrium. The final 2 minutes from 3:28 p.m. to 3:30 p.m. This brings us to the absolute climax of the trading day. And why is it so tense? Because you literally don't know exactly when it will end. At 3:28 p.m., the random close window opens. The exchange deliberately ends the session at a totally random microsecond between 3:28 and 3:30 p.m. This is brilliantly designed to defeat traders or algorithms trying to snipe the final second with massive orders. The hammer could fall at 3:28 and 10 seconds or 3:29 and 45 seconds. You just don't know.
Now, what's really interesting about this is how the exchange actually decides the final price when the music stops. They don't match orders first come, first served anymore. They look for equilibrium. They stack up the cumulative buy demand and the cumulative sell supply at every single price level. For instance, at 2,510, we have 1,000 shares of supply, but only 200 shares of demand, meaning only 200 shares can actually trade. Down at 2,500, we have massive demand of 1,200, but only 400 shares supplied, so only 400 trade. But look right at the middle level. At 2,505, the buyers and sellers intersect to allow a massive 600 shares to trade. Because 2,055 allows the absolute highest volume of shares to change hands, that becomes our magic number. Boom, 2,055 is the official final closing price for the day. All 600 of those matched shares are executed at exactly 2,055, regardless of what specific limit price the trader originally entered, as long as their order cleared the equilibrium. It is a beautifully mathematical yet incredibly strict system designed to find true consensus while completely shutting down wild end-of-day volatility. But it does leave us with a fascinating, provocative thought. In a world where precision is everything, with a randomized 2-minute closing window that literally takes away the final second, how in the world will high-frequency algorithmic trading adapt to survive this new final bell? It's a real puzzle, and it's a question every institutional desk in India is scrambling to solve right now. Thank you for joining me on this explainer, and I hope this gives you a much clearer lens on the markets of tomorrow.